Hi, what I want to do now is to focus on an accounting issue which has been problematic for accountants for a very, very long period of time, and that is accounting for leases. To understand why accounting for leases is problematic, you'd first need to think about what leases are and what is it about them that makes them potentially problematic. You could say that lease is simply a contract. It's a contract between two parties, a lessor and a lessee, and the lessor gives the lessee the right to use an asset for an agreed period of time in exchange for the lessee making payments or a series of payments. That doesn't seem too complicated, does it? But what we need to appreciate is that leases are incredibly diverse in their nature, and that's where the problems start to stem from. The diversity might be the sheer magnitude of the transactions, and some leases can be quite small and quite trivial, whilst others might be quite significant material assets. Likewise, we can have assets which are very short and have leases which are very short in duration, and we can have leases which are very long in duration. And at the end of the day, that makes it very hard to prescribe one accounting practice which is going to be suitable for all situations. Probably the best way of identifying this or clarifying what I mean by this is to think about two simple lease transactions. Here we have someone who has leased, rented a rental car for the weekend to go on a trip, and that would technically be a lease. But we can also have a lease of an aircraft, a much more substantial asset, and the duration of the lease is often going to be for 7 or 10 years. And when you think about it this way, it's probably difficult to imagine how you could have one accounting practice which is suitable for such diverse transaction types. We might look at the conceptual framework to see if that provides us with any guidance. And if we look at the framework tells us that liabilities arise when people have obligations, and assets arise when there is control. In relation to a lease, and if we just focus on the lessee for a minute here, does the lessee have an obligation to make lease payments? It's a contractual obligation, so you'd argue yes. And likewise, you might argue that the lessee has control of the asset, and that would suggest that you have to recognise an asset pursuant to a lease. But it's not altogether that simple, because at the end of the day we need to realise that it really depends upon your perspective. And if you adopted a very legalistic perspective, the lessee never owns the asset, legal title, so therefore is it appropriate to recognise an asset? Or alternatively, should you emphasise the economic substance of the transaction, and that is that the lessee does have the use of the asset? If we think about the framework, it probably does suggest more of an economic perspective. And so if we look at the framework, it's probably going to say that leases do give rise to assets and liabilities for the lessee. The accounting choices that we have for leases are really a function of whether we believe they give rise to assets or not. And if we think about the decision that assets and liabilities don't arise from leases, then we don't recognise them. And in that case, we'd use what is referred to as the lease expense method, which simply means that we recognise the lease expense on the basis of which the payments are made. Alternatively, if we believe that leases do give rise to assets and liabilities, that would suggest an accounting practice which might be described as lease capitalisation. And under lease capitalisation, at the inception of the lease, the lessee would recognise an asset and a liability. I'm not getting into how these might be measured. And because you recognise an asset, that asset would have to be depreciated, and that liability would have to be repaid with interest over time. So those are our broad accounting choices: lease expense or lease capitalisation. One is consistent with recognising assets and liabilities, the other is not. If you do go down the road of lease capitalisation, the issue becomes, well, how do you determine what the asset and the liability is? In relation to leases, they may be characterised as having, or they are often characterised as having, fixed cash flows from the beginning, and there is typically a price associated with these cash flows, a discount rate. And so one approach might be an historic cost type approach. And historic cost I would characterize as being appropriate where you have constant cash flows and you maintain a consistent discount rate over the period of the relationship. So what you might do is you might have here, as you can see in the table, you might have a series of payments being made, $25 million a year for 5 years. It's discounted at 8% and the present value of that's $100,000, and you would simply amortize that on a principal and interest basis over the duration of the lease. That's an historic cost approach. An alternative way to measuring the liability is to have more of a fair value approach, and what you can see with this approach here is that we distinguish between historic cost and fair value by allowing the discount rate or the price of money to change over time. So what you can see in the table here, which is more like a fair value approach, is you work out the fair value of the future cash flows every period at a changing discount rate, and you recognize the interest as the difference between the payment amount and the change in the underlying liability. We can talk about that more later on. Does it matter whether you recognize an asset or not? Well, we know that from the way firms have chosen their accounting policies that firms definitely prefer to keep the assets and liabilities off their balance sheet, and they have historically preferred to use what's referred to as the lease expense method. We can see this because recognizing the asset and liability is going to have impact on leverage ratios, and there's evidence that firms are quite sensitive to leverage ratios and they base their accounting policies on that. We know that in the period before leasing was first regulated, firms tended to choose the lease expense method, and in the post-regulatory regulation period, what Imhoff and Thomas found was that firms rearranged their leases to make sure they could still use the lease expense method. And we know that the information about leases is relevant for a whole range of decisions, credit capacity and credit worthiness. So firms are particularly sensitive to how we account for leases. If there's any expectation as to what we should be seeing in IFRS 16 to AASB 16, which addresses leases, we can think of the conceptual framework. And the conceptual framework talks about faithful representation and the economic substance of transactions. And that should probably dictate or guide how we think about what's going to appear in this accounting standard. We should also think about what the standard is going to dictate to ensure that we have consistency or comparability across transactions which have the same economic substance. So for example, if we focus on the lessee, what's the difference between borrow and buy as opposed to leasing? So if you have borrow and buy, you have a loan and you have an asset. If you have a lease, you have a leased asset and you have a leased liability. Surely they should be accounted for on the same way. And that would probably be suggested both by 1, ensuring faithful representation, and 2, ensuring consistency. For the lessor, it's probably less problematic. The lessor who finances the transaction, they probably don't care whether they recognize a loan receivable or a lease receivable. All they care about is that it's a receivable, and so lessor accounting for leases has always been much less of a problem. So where to from here? Well, we obviously need to get inside IFRS 16 to AASB 16, and we're going to do this in a 3-stage process. We're going to start off and see what the standard has to say about accounting for leases generally. This is scene setting. Before we focus separately on the accounting requirements for lessees, and finally the accounting requirements for lessors. I would generally speaking suggest that people focus on lessees and make sure you understand those in their entirety before you move on to lessors. So we'll stage it out.